Okay, this is Rhonda Thomas. We're getting ready to do managerial accounting, the 4 bigger problems in chapter 12 with capital investment analysis. We are on the first one, and all of our problems are algorithms. So you're going to need to look at your numbers and do calculations for yourself. So I would highly recommend using Excel or some form of a spreadsheet. And I have just put in, this is our first problem. This is 12-1A. We're looking at 2 different options for capital investment. And I've just keyed in my robotic information, which you'll see is the same amount every year for income and the same amount for cash flow. I'll get to the rest of this here in a second. Now I'm going to key in the warehouse option. You'll see the warehouse option is not an annuity because each amount, and that includes the net cash flow as well. All of those amounts are different than each year. So therefore, these do not qualify as an annuity. Okay, so the annuity definition dictates which table you can use. Now, we've only been given the present value of $1. It does not have the word annuity in it. So we don't have any choices to make, and that's a good thing. But there are times that you're going to have to know which one to use. Okay, so let me go ahead and finish what I'm doing. I'm keying in the information they've given us about these investments. Okay, now where they get all this information, I haven't had any experience myself, but they would have to research all of this. And by the way, all of this is an estimate. This is all an estimate. There is no guarantee that any of this stuff is going to come in exactly what this says. Okay, so you do have to also take that into consideration. So once you key in the information they have given us, here's the other thing you want. Each one of these is going to have some form of an investment or cost of that project. Both of these projects happen to cost exactly the same, which is pretty convenient. So I'm going to put the fact that both require the same investment. So I just put that one place on my spreadsheet. It also says that they have straight line depreciation and there's no residual value on either one of these assets that they're thinking about investing in. The last piece is that the committee decided that their rate of return for either one of these, when it comes to net present value, they're not going to accept anything under 15%. So I put that in yellow. So my brain looks and goes, okay, anything under 15, it's out. So now we're ready to start our analysis. The first analysis we're going to do is the average rate of return. That does not require any present value. Here is the calculation. I did put it here. So you're going to take the average annual income divided by the average investment. Here is the calculation of the average investment. Okay, I have put in, and I'm going to see if my template is working. Okay, see if it's working. So what I've got to put in here, because I'm displaying for you how I'm calculating this. So what I'm doing is I'm going to take, and this is the operating income, that is 304,500. I've got to show that is my operating income, because the last problem I did, it was 270. So mine is 304,500, and I'm going to divide by 5 years. That's my numerator. Okay, that's my numerator. Then the denominator is to take the cost of, or the investment of the project, add any residual value. Okay, in accounting, hopefully you're catching on to this. When you're supposed to add something, I always put a placeholder, because They said there was no residual value, but I put that in there to let anybody who's wanting to know if I calculated it right, that I did check for that. And I would highly recommend that. Then we're gonna divide by 2. So here is your denominator. So you're gonna have a number here and a number here. And I wanted you to see my calculation based on my information. And if it's working right, which I'm gonna check it here in a minute, here's what I've got. So more than likely, I've got something in there that I've got to change, okay? So here's how I'm gonna check it out. Okay, I'm gonna check it out to make sure that it's right. Because when you set up templates like this, there's always a chance that you might have something out of whack. So what I've got is to take my operating income divided by 5, so that looks okay. And then we're going to divide by the investment plus residual value divided by 2. Okay, so I don't have any numbers in there that I can see that need to be changed. Okay, so that is what I have. Now we're going to go to the warehouse. Let's do the warehouse's average rate of return, because this, believe it or not, it's going to be exactly the same. The thing you don't see, and there's something I've got to change here because I'm not coming up with the same number. You should get the same average rate of return for both of these projects. Here's why. Because if you look down here, notice that the total operating income is the same. The only difference is when, oh, nope, those should be different. Okay, hang on. The only difference that you're going to see is the amount of income is coming in earlier for the warehouse. The robot is coming in an annuity method. Okay, the same amount, same amount, same amount. But this one is coming in faster. Okay, it's coming in faster. That will affect our present value, but this should be the same. So let me see what I've done here and what's going on. So this should be, I should be able to copy this here. So I will double check what's going on. All right, and that's okay. So once again, down here, same formula. You go get your total operating income and divide by the number of years that that project is supposed to operate. Okay, so mine is 304,000 divided by 5. And then we're going to divide by the cost, which is 540,000 plus residual value divided by 2. So let me see what I have wrong. Okay, here's what I have wrong. I don't have the right total income. Okay, so once I key this in or make it reference, making it reference works out better because it stays put. So now I have exactly what I have here, and using this analysis gives us no difference. Gives us no difference. And you say, what? That's just how it calculates. So when you get no difference, you go, well, I guess we could pick either one and we're going to get the same results. Well, let's go a little bit further and add the net present value to see if it comes out the same. Okay, so here we go. The net present value is going to use the cash flows, not the incomes. All right. So if you've listed your cash flows, then that's good. And they're both 925,000 in total. But like I said, if you look at the difference, one is coming in evenly every year, and the other one is coming in descending order. So you're bringing in the most cash flow the first year of the warehouse and the least cash flow the last year. And you have to think about time value of money. If years are involved before you get those funds, that makes today's money worth less of what you're going to be getting 5 years from now. And the farther out it is, the less it's going to be worth in present value money. So what I want you to do is look at your minimum rate of return. Mine is 15. I don't know if we have the same one or not, but that's the number we're going to use to look up this here on this table. So I put 15%, and it applies to both investment opportunities. And you're going to just key in exactly what the factor is for the first 5 years. So you key in, if yours is 15%, you key in 0.870, you key in 0.756, and so on. The good news is you can just copy and paste this once you put it in, because it's going to be the same for both of these projects. Okay, so that's how important these tables are. And the interesting thing is, because we got the same amount for our average rate of return, which by the way, I haven't put in yet. Okay, I'm going to put 1 decimal place. Okay, even though I don't think I have anything after that. Oh, I do. So hang on a minute. Let me follow my instructions to maybe I can get it more correct. Okay. Ooh. All right. It says round your answer to 1 decimal place. Okay. I didn't have that yesterday. So here we go. Lord only knows. Oh, and the other thing is, well, when it comes to present value, there is a chance when we calculate present value, which is not what we're doing here, there's a chance that it could be negative. Okay, so, but your average rate of return shouldn't be any negative amount. So I'm going to put this in as instructed, but it's supposed to be the same. So I'm a little concerned that something's wrong, but it's okay. We'll see. All right. I'm gonna, okay, let me put in what I did last night. Okay, so I got 23% as a whole number. I'm gonna put that in. Oh no, I'm gonna put that in, and I want it calculated. So let me go back where I was. Okay, yeah, I'm gonna put 23.0. You guys might try yours and see what you're getting. A lot of this tends to be because of a rounding issue, okay? And I'm just going to check it. Okay, it doesn't like it. Okie dokie. All right. Hold on. I have one. Here's my change that I did not make. But because I have this, I'm going to be able to change this pretty quickly. So guess what my investment is? It's not the same as it was last night, and I just didn't catch it. So I'm going to put this in here, and boom, there goes my percentages. There you go. So this is the working papers that you would want to present to your boss if you were doing something like this, so that if you made an error, you could change it pretty quickly. So now let's see, but you still have to put it in as 21.0, I believe. Okay, whoo. All right. That is the anxiety-filled life of accounting. And it's still, hey, it got it. Yeah, that's the anxiety about accounting. Did I put everything in correctly? Right? So, all right, now we're getting ready to do the present value. Okay, we've put in all of those present value factors from the table, right? Under the 15% column, because we're looking at 5 years. That's why we're putting all of those in. But once again, when you put one set in, you can copy and paste it down here, so you don't have to. Now you need a formula. Here's where things are going to change, because you're going to take each cash flow times whatever factor is sitting here to get the present value of that cash flow, okay? The present value. And like I said, the first one is the first year's cash flow. And even the first year's cash flow is discounted. That's what they call it when you're using present value. It's less than what the real amount was because a year has passed. Okay, so as you go down through here, you'll see that each of these that was 185,000 is now a different number because of the factor being different, right? So once you do a formula that takes that cash flow times that factor and get a number, then you're going to add up all those present value cash flows to see what your present value total is for cash flows, right? Yep. How much is it without time value of money? How much are we expecting without time value of money? How much are we expecting with the idea of time value of money? Quite a difference, right? So what we're going to do then is do all these calculations. This is using time value of money. And you can see that's quite a different amount. Then we need to remember, how much are we investing? So it's a good thing I remembered that I didn't have the right investment amount, because this one would have been wrong too. Then we're going to subtract that amount that we are spending to start either of these projects. And then if we have a positive number left over, then that's a green light that says, well, at least we're going to have more benefit from this project than it's going to cost us, okay? But now you're going to see a difference. You're going to see a difference in the projects. And the reason is, like I said, this warehouse is bringing in larger amounts of cash flow in the earlier years than this one is. And that's going to create more present value total of the cash flow. And then you still subtract the same investment amount because they were priced at the same, but this one is quite a bit different in present value. So what I have in green here, you're going to want to fill in. Here's the robot option. Here's the warehouse option. So what I see here, I'm going to key it in. Be sure to key in negatives for anything that has to be subtracted. And this is where you could end up with a negative net present value, because if the project costs more than your present value total, then not only should you not do it, it's definitely going to be a disadvantage as far as your calculations are concerned. All right, so key in what you get when you do this net present value analysis. Okay, so it's just exactly what I have here, and be sure you use the information for the robot going vertically, okay? Okay, and picking out the pieces and putting them together in a way that you could change something quickly helps a lot. Okay, so my warehouse is $672,219. Okay, same subtraction of the cost or the investment, and then much different, more than twice the amount of the net present value for that particular option. So if our capital budgeting committee needed a recommendation, we didn't get any help using the average rate of return because they were the same. But we did get some guidance when we used the net present value, and it looks like the warehouse is the best option based on what we have here. Okay, And the fact that they're both the same investment also helps promote that this present value is helps with the decision. All right, so here's the report. The robotic assembler has a blank net present value, okay? So it should be a smaller net present value than the cash flow of the warehouse, right? Yep. And the reason is, okay, so one more time, the robotic assembler has a smaller net present value because cash flow occurs later in time, right? You're only doing 185,000, even clear into years 4 and 5. So that's a lot smaller amount as time is larger, right? So compared to the warehouse, thus, if only one of the two projects can be accepted, we would probably recommend the warehouse. Now, I don't like the word here, would be more attractive. Well, I've never really used that in accounting. I've always used favorable or unfavorable or preferred. I don't know. Anyway, I guess that accountant likes the word attractive, but okay. So the fact that two different analysis of these capital projects give you different information is the justification of why you might do all 4 of them. Okay, you just might do all 4 of them. See what you get, okay? Is there anybody that needs any help with this? Now, you might not have had a chance to do all of this, but I am doing this on a video right now. So if you need to go back and I don't remember what we did there, should be able to get there. Okay, because I'm going to go on, if it's okay, to the next one. So we're going to do something pretty similar. We're going to use another set of measures for 2 projects. So what I did was I just copy and pasted this right down here and then changed all the variables that I needed to. So I do need to make sure that all my new stuff is set up. So you can watch me if you want. And like I said, I had a pretty good audience last night. That was kind of cool. Okay, the next one. The next one, we're going to compare 2 projects again. Okay, this time, instead of the average rate of return, we're going to use the one that's called the payback period. And then we're also going to use the net present value. Okay, so we're going to use that same method. So we should be able to use the same table to do some of this. Now, when it comes to the payback period, we're not going to need any income. So notice we did not get any income. The only thing we got here is numbers about the cash flow. Okay, so we're not getting any income for this one. So, but we are looking at the same set of years. So 5 years, 2 projects. Okay, 2 projects. Both projects have the same investment. So that will work for both of the projects. The rate of return, however, is for mine is much lower than what I used last night or what I just used in the previous problem. All right, so here I go. It also, to make sure. All right, so here is the cost of both of my investments. It's 234,000. My minimum rate of return is 6% instead of 10. The cash payback period is, here's how you calculate it. You take the initial cost and you divide by the annual net cash inflow. Okay? Now let's put in these numbers for each of the projects. Okay, there's a little problem with this calculation, and I'll explain it here in a minute. So if you'll give me just a second, I'm going to put my cash flows in where they go. So the first project is the plant, and the second one is a retail store that they may decide to expand. All right. So I'm going to put in my different numbers here to try to make this pretty easy. But it did take me a while to get this set up and I kind of understand what's going on. Now I'm going to put in the cash flows for the retail store. Okay. Now I'm going to ask you guys, if you don't mind, remember when I was talking about an annuity? What's the qualification for something to be an annuity? You have to have more than one cash flow, and the cash flows have to be what? The same every year. So guess what? Neither one of these qualifies as the definition of an annuity. It does so because it's more than one amount, but it gets disqualified because it's not the same number every year. This is the rub for this formula that we're just about to use for the payback period. Okay, this is the rub. Okay, because these are not the same. These are not the same amounts of cash flow. You really can't put that in there. If these were the same, then we could put our divisor or our denominator in as that amount, but they're different. So I'm going to change this formula just a little bit. We're going to start with the initial cost. Okay, the initial cost. The formula is supposed to be the initial cost divided by the annual net cash flow. All right, I'm going to change that. We're going to take this year by year. Okay, year by year. So I know they didn't do very good, I don't think, but all right, we're going to take that initial cost, which mine is $234,000. So I need to change that. Okay, so my initial cost is $234,000. And I'm just going to subtract the first year of my cash flow. Okay, whoop, hang on, I got to fix this. Okay, I'm going to subtract the first year of my cash flow. And when I look over here, my first year of my cash flow is 129,000. So I'm going to change this. I'm going to change how this looks. Okay. I'm going to make this equal my cost right below that. And then I'm going to subtract the first year. Okay. I'm going to subtract every year I need until I've paid myself back. Now that sounds weird, but if you bought a microwave or a bunch of stuff to quit eating out in your dorm room, let's say you spent $200 at Walmart and you bought all these gadgets to make sure you could fix all the things you want to eat and not go out to eat.
Yeah, but then you gotta buy all the food to eat too.
Okay, but before you start figuring out how much you're saving by not going out to eat, you've got to recoup yourself what you just spent. So that's kind of the idea of this payback method. So if a business decides to invest in this, they want to see how many cash flows it's going to be before they're paid back, and then they'll start making money. Does that make sense? So unfortunately, because the cash flows we were given weren't the same every year, we're just going to have to go year by year until the initial cost is zero. All right, so that's what I'm going to do. So I got my initial cost here, my first year, right? So I'm going to subtract the first year, cash flow first year. So cash flow first year. All right. And this is the cash flow, not the present value of the cash flow. So remember, the payback period doesn't use any time value of money. So you're simply going to use the cash flow that they have given you. So my first one is to take my cost and subtract, the first cash flow that I have been given. So I'm trying to show you the formula here. So you take that initial cash flow, and I'm going to put the amount of my cash flow in the cell next to this, and I'm going to do the subtraction here. So what's left after the first year, when I do the math here, all right, is my initial cost minus the first cash flow. I've got $105 left over of my initial cost. Okay, I'm going to bring that down here. I'm going to just make that equal what that calculated. All right, and I'm going to move this down a few before I go any further. So I got to make this look a little different. I had a little troubles with this last night because it's like, wait a minute. At first I thought you should just average the cash flow to get the same amount every year, but that's not going to work. All right, so once again, my first attempt to see if the first year's cash flow would pay me back all the way didn't work. So now I have 105,000 left over of my initial cost. And once again, I'm going to move this down a few rows to get it out of my way, because I'll explain if it's 2 years or however many it is. All right, so now I need to go look at my cash flow for the second year. So I'm going to go over here. Oh, it's magically 105,000. That is exactly what I had left over of that initial cost when I subtracted my first year cash flow. Okay, so when you do the math, do you have any cost left over? I hope that's the way yours is. I'm hoping. If it isn't, you might have to do another year, okay, after that. But but this can get kind of dicey because, you know, that's not likely to happen, okay? You say, okay, so the answer for me is 2 years. Why? Because this is how many cash flows it took for my initial cost to be paid back. All right, and that's the point of the analysis. It's called the cash payback period. So cash flow coming in, because we did the project, we got to pay ourselves back before we can really do anything else with if this is going to be a project to work for us. Okay, so with that being said, we're going to do that now for the store expansion. All right, for the store expansion. So let me get this back up here where I need it to be. All right, and we're going to calculate just like this. Okay, so I'm going to move this down a couple of cells, and we're going to just put this in here because, but it might not be this. So we'll put what we need to in here. So your spreadsheet may not be set up this way, but I need to set mine up. And once again, trying to think of a good word to put. Yes, you're going to subtract the cash flow of year. I'm just going to put of year. It might be beyond the first year. It might be beyond the second year. It might be 2.5 years. So you may only get half. If this was 105, and if their cash flow was only half of that, then that would be 1.5 years. Okay, so I didn't think about this being so complicated because I've only worked this when we had an annuity or we averaged out the cash flow, but they won't let me do that on this one. So I got to go with what they say. All right, so now I'm ready to put this in down here. So once again, we're just going to list the initial cost, which is the same for this project as well. And I've got that at 234,000 listed here on my spreadsheet. And now I'm going to go get my cash flow, which is not the same, right? Not the same, but I think it makes up for it. So their first year, my store first year's cash flow is 108,000. And that's the amount I have to subtract. Okay, so we'll see what we have left over after we subtract the first year's cash flow. So I think it's magically going to be the amount. Oh, it is. So I'm going to bring this down here. So there's the amount of the initial cost that's left over. And now I'm going to go get my second year's cash flow listed right here. And the author of this problem made them magically come out exactly right. Anyway, so I'm going to take my cost I had left over and subtract that second year's cash flow, and it's paid back. So magically, both of these for me is a 2-year payback period. If you have a chance to calculate yours and you want to tell me what yours end up to be, yours may very well be something close to that, but I would expect this to happen. Okay, I would expect this to happen. So hopefully that's the case. And look, right? How many years do I have to pay myself back? 5. So if I don't pay myself back after 5 years, then that's a project we shouldn't even be doing in the first place. Okay, so once again, my payback period for both of these is 2 years. So kind of like the first one we did, when we did the average rate of return, a 2-year payback period for both of these doesn't help us decide which one to do. Okay, so we're going to take it a step further and do a little time value of money calculation. Now, here's where I have to change something. I have to go to my present value factors, right? We've got that same table, but I've got to look up my factors for 6%. Notice you don't see 7 and 8 and 9. In a real table, you would see, right? Or you would calculate what that factor would be, okay? Or put in something close to that. So 6% is what I have. So I think these are the only possibilities for your minimal rate of return here. So I'm going to put 6% and I'm going to key in what those are. And then I'm just going to copy that for the store option. Okay, copying it for the store option. So I'm just keying in my present value factors under 6%. And I'm going to key in the first 5 years. Okay, first 5 years. And then I'm going to kind of make sure, because it's real easy to get offline and key in the wrong thing. Okay, so I'm trying to be very detailed. That's hard for me to do sometimes and narrate at the same time. But if Bob the hoof guy can do it, so can I. Have you seen him on Facebook cleaning calves' hooves?
Yeah.
That guy's voice is amazing.
Yeah.
And I still say that that is his voice and his ability to narrate what he's doing. My sister even started watching him, and I'm like, why are we watching this? But he's making a lot of money.
Yeah.
All right, I'm going to use this same table and put it down here because we need to evaluate it based on the same present values. Okay, so I think I got that in there. Now I need to make sure that my formulas are working to calculate the present value of each of those cash flows. So I'm just double checking those. Okay. And the reason, because notice the cash flows are different. If they were exactly the same, they would come out to exactly the same present value of the cash flows. But because like this project brought in 129,000 the first year, but this project only brought in 108,000 in cash. Vice versa. The second year is 105,000 and so forth. So each of those years are different, even though they're bringing in the same total of cash flows. It's these present value factors times each of those cash flows that makes the difference. So when I do the math, now I got to go back and remember what my investment is 234,000. So I needed to make sure that was being subtracted. And there is my net present value of the plant expansion. And now when I do the math for the store expansion, there is my present value total cash flow. Notice this one is a little lower than this, not a lot, but it is lower. And I'm going to do something that I did last night with my student. I want to know what the difference is in the cash flow just for the heck of it, even though that's not what they're asking. They'll just want you to put this in, and then they'll want you to report which one's giving you the most net present value. Well, mine is the plant, okay? But it does help to see how much the difference is, right? And the difference is in the calculating the present value. Now, the fact that they're the same investment, that's not a difference. And one more thing, accountants love, or financial people love to see what the percentage change of something is. So if somebody said, well, 2,430 is the difference between the projects, somebody's going to go, you got a percentage on that? And so what you would do is you would take the difference that we just found, and I would pretend that this up here is my oldest amount, okay? And I would divide, the lower is the oldest. That is what I would choose. Actually, I'm just going to use this one. That's fine. It's fine. But okay, so then I'm going to turn that into a percentage, even though they're not asking for it. So 2% is the difference between the present value, the net present value of both of these projects. Now, that information might be needed, right? Even though they're not asking for it, but I would want to know that. Okay. All right. So I'm going to key this information in green right here, just like we did for the last one. And then you're going to see the fact that the net present value is different. And then the one that mine ended up being more was the plant expansion. Okay, so I don't know if yours is going to follow that or not, but I wouldn't be surprised, because I do think they kind of, even though they're different numbers, they're trying to make the same kind of problem happen. So maybe that will help you. I don't know. I just don't know. I didn't get a chance to find out last night what's going on, but I haven't heard anything yet. All right. Okay, and then so my second option, I believe, okay, and that, I just want to make sure, that was the store. And I'm even a little paranoid because I want to make sure that I've got the store lined up where it's supposed to be and the plant lined up where it's supposed to be, because you can easily put the wrong things in. Okay, so I'm going to check this now, cross my fingers. All right. And once again, what's causing this difference? What's causing the difference is that one option is bringing in more cash earlier. So that makes that cash flow worth more in today's money than something out 5 years into the future, right? So that's how the time value of money works. And it can be sometimes kind of hard to get your mind wrapped around. But because of the timing of the receipt of the net cash flows, that means what year it's coming in. The blank offers a higher. So mine was the plant expansion. offers a higher net present value. Net present value, that's also oftentimes seen as NVP. That is a very popular acronym for net present value. And you know, net always means something's been subtracted. All you ever need to do is look at your paycheck. We wish we could take home our gross, but it's not going to happen. Okay. We always take home net pay when we have a paycheck, unless you're getting paid under the table. So, but no, but anyway, and I will say the agriculture world sometimes has different rules about how people get paid. So I don't want to create any kind of misinformation there. So anyway, net pay, something has been subtracted when the word net is there. And it's good to know, to think about that when you see it. Okay. So that's what we've got for that one. Where are we at? 10:33. Okay. I do want to go ahead and finish up the other two. So you do what you need to. If you want to keep working on what you're working on, that's just fine. Or if you want to watch the video later, I'm just going to let you make that call. But I'm going to move on so I can get these other two in here. Okay. So now we're going to do one that uses just, I got to double check that my answers are okay. All right, there we go. So one more time, the second one we did used the payback period. Payback period does not use time value of money. So for whatever reasons, because the investment was the same, because we actually had the same amount of net cash flow in total, both of these have the same payback period. So there's really no help from this that one of these is preferred over the other. But when we took the time to consider the present value of all the cash flows that are expected, then we did get a difference. Okay. So that's, once again, that is the reason to use more than one analysis when you're getting ready to spend a lot of money, right? They're thinking about spending $234,000 on either one of these. So they need to justify why they're picking either one. Okay. So, all right. This one is going to use the net present value and one that's called the present value index. Because we're using both of those use present value. So we're going to kind of follow along. This time, we're going to use 3 options. The 3 options have what? Different investment amounts. So, okay. And then we're only looking at it for 3 years. But each of the 3 years has different amounts of cash flow, depending on the option. Okay. So here's where I'm at. Go down here. The very first thing I like to find most of the time is I know they're going to have to tell me somewhere their minimal rate of return. And it has to be the same for all the projects, because that's the only way you're going to be able to compare it using this table. So I'm looking here, and this is where I would look if you're following me. Go find your minimal rate of return. And I've got to change that to 12%. Okay, and I'm going to move her up so she lines up. So I want to delete that and move it up. Okay, that's the first thing I would do in this problem, because the other two we did, the investment was the same, the total cash flow was the same for both projects. So this is going to make some differences here, but that's okay. All we got to do is follow the recipe. Okay, follow the recipe. So let me move this up, because we want the 3 years of the cash flow put in for each of these projects. Okay, each of the projects. So I'm just going to bring this up. There we go. So let me key in my information. And then you also need to key in the investment. We'll key in the investment last thing, because the only thing you really need to do with that investment for each project is to subtract it from the cash flow, the present value cash flow that you find. So the next thing I would do would be to put in the cash flow they're giving you for each of these. So we've got an option to maintenance equipment, or make ramp facilities, or buy a computer network for wherever we're at. We're a railroad company. Our 3 capital investment proposals are here. And we are going to use time value of money for both of our analysis for all 3 of these. And luckily, they're only looking at 3 years. So the second step I would do after putting in how much my minimal rate of return is, I would go put in the cash flow for each of these options. Okay, so that's what I'm going to work on. And then we'll see what happens. Okay. And see, they didn't even give me a total of this. Yep, I didn't get a total here, so I really want to be careful that I have put in what this matches, right? Or I'm going to get really out of whack. Okay, I'm going to the second option, which is the ramp facility. I'm putting in the cash flow. So key that in. And I know it's hard to follow along with someone who's already got something, a table to put something in. So I do understand if you're kind of waiting to watch it later. Okay, the third option is the computer network. So let's put in the cash flow for it. Once again, I'm going to try to be ultra detailed. Sometimes. Okay. All right. Okay, the next thing is, now what was my minimal rate of return? That's going to matter when it comes to looking at the present value table. Because we have different amounts of cash flow, we cannot qualify these as annuities, so we have to use the table that doesn't have the word annuity, and that's what they gave us. So I'm going to be looking at 12% for all 3 of these. And I get to use the same factors. Okay, and that's okay. That's helpful. Get to use the same factors, so I don't have to key that in 3 different times. But I need 12%. Okay, so my first 3 years of the factors that I want to key in is these 3 here. Okay, that's going to be the present value factor that's going to be multiplied by the net cash flow that we've been given. Okay, so 0.893. 797. Point. All right. So I think, just double check. 893, 797, 712. Okay. So here's the next piece I would do. I would multiply so that you get the present value of each of your cash flows times whatever factor that you just keyed in based on your minimal rate of return. So mine doesn't want, my problem wants to disqualify any project that does not at least produce 12%, okay, of a return. Okay, so we'll find out whether or not what happens here. Okay, so the next thing I would do is I would make sure these formulas are working. So you need the net cash flow times each of the factors. And because each of the factors are different, you're going to get a different amount of a present value for each of those, because also it's further into the future. Notice the further you go into the future, what happens to that factor? Goes down, right? It goes in descending order. Good thing we're not doing this out over 10 years, because look how low these factors are. Yep. So that's how it works. Okay. And then once you've calculated the present value cash flow, you add it together to see what the present value total of the cash flow is. And then here's where you're going to key in your investment amount. Okay. And they're all different. So I figured we might as well just wait until it's time to key it in. Okay. My first option, which is this maintenance thing, to maintenance the equipment, the amount the company's going to have to invest is $913,798. I'm going to put that in a negative so that it subtracts, and I can see that it did. That's another reason to put in the sign of what you want something, so you can see that it did subtract. Okay, because if it didn't subtract, right, then okay, so let me just double check this. My cash flow, unfortunately, let me double check I've got that. My cash flow on my maintenance equipment is lower than the amount to be invested. My amount to be invested is actually $913,798. What's that doing to my net present value? My net present value is calculating as a negative. Is that a good thing? Not for that project. Not based on the estimates we have. No. Okay. So just leave that there. We'll put that in here in just a minute. So now let's go to our other project. Okay. I want to make sure that all my cash flows are calculating. Okay. And then I want to make sure they add up. Okay. Because we're only doing 3 years this time. And then my investment for this ramp facility project, I'm going to key that in. So 593,059. Okay. So this project is a little better outcome from our analysis. It's saying that after we subtract the cost from the total present value of the cash flows over the next 3 years, we do have a positive number, which is definitely more favorable than a negative number. Okay, so just leave that alone. We'll put this in just as soon as we're finished. Now we're doing the third one, the computer network. Okay, the computer network, here is the cash flows and then the present value of each one of those. We want to take the cash flows times those factors so that we get present values. And present values then need to be added up for a total of the 3 years. And then we're going to subtract the amount invested. Okay, so mine is a negative 291,230. Okay, so based if everything is calculating okay, this is also a net present value that's favorable. It's not as favorable as this one because the higher the number, the better. Okay, the higher, the more favorable. So let's go key in all these calculations I have here in green. So it starts with the total present value of all of your cash flows, subtracting the investment to get to your NPV. All right. So I'll let you do your thing, whatever you're working on. I'm going to be sure to put my negatives in, or I think it'll count it wrong. But like I said, I really like seeing the sign, and I'm so glad that Cengage must have gotten a lot of complaints over the years that we couldn't see the sign. Yeah, so that really helps a lot. Okay, there's my first one. So it looks like maintenance is a no-no anyway. Even if we were just looking at it by itself. Okay, we would probably go, well, we need to either recheck our estimates or something. All right, 634, 573. And then the amount invested gets subtracted. And then the amount that's left over. Okay, and then the computer. Okay. All right, so let's see, got everything okay. Now, which ones has the biggest net present value? It looks like it's the rent, okay? Now we're going to calculate what's called the present value index. So we are going to be able to use a little bit of the numbers. Oh, no, we are going to use the numbers here to calculate this net. Okay, the present value index, okay? The present value index. Let me explain to you what this is doing. Okay, so I've got it in green here, over here, but it is going to use some numbers that you've already worked on. So you'd want to do the net present value first, and then the present value index. Okay, so here is where I'm calculating from. What this is doing is it's going to start off with the present value total with your and I gotta think about this. Okay, because that okay, so here it is. Yeah, this is right. It's gonna take the present value total of your cash flow, which is over here. So it's gonna take this number and it's gonna divide by the investment that you made. Now, remember when you divide a number by a negative number, it makes the negative go away. Remember that? Okay, so you're just going to get a whole number. You're not going to get a positive or negative because it's a division problem. Okay, so don't worry that the index itself is not a negative, but the net present value was. Okay, so I'm going to see what happens here. So here's my number. Okay, now I do have a negative up here, and I'm going to try it because I don't remember whether it took it or it didn't. But here's the idea of the present value index. And if you guys wouldn't mind listening for just a minute, I'm going to make a rule about that here on my spreadsheet. So your present value index, here's what it's telling you. All right. At the very least, your present value index should at least be 1, okay? At the bare minimum, okay? At least 1. If it's 1, you are breaking even because you're taking the amount that you calculated in cash flow and subtracting its cost. And if the cost is more than your cash flow, you aren't breaking even. You're not getting more benefit than you're giving up, okay? So the fact that this is less than $1, that's not good, but we're going to compare these indexes with each of these 3 projects now. But once again, the present value index should at least be 1. Okay. Let me see if I can rephrase this. Present value index, if it's equal to 1, that means you're breaking even with your cost to benefit analysis, okay? So present value index is kind of a cost benefit analysis. And if you get at least 1, then you're breaking even, so to speak, okay? Your cost equals your benefit, okay? And so you wouldn't usually want to do anything that wasn't at least an index of 1. Okay, I hope that makes some sense. Okay, so I am going to put 2 decimals there. And this isn't dollars. Okay, it's not dollars. It's for every dollar that you invested, you are getting $1 in benefit. Okay, so you're really not any better off or any worse off. Okay, but you're going to be worse off for something that is a negative. Okay, so what do they want? They want 2 decimal places. I'm going to test this index, see if they want this as a negative, because to me it would make sense that they would, because it's going to be less than. So I'm going to put this in here, and they want it to 2 decimal places, and that's as far as mine went. So I'm going to see, okay, it doesn't like it. So now I'm going to change it to this, and maybe I did something wrong, but look. So they didn't follow their own rule. So I'm sorry, that's the case. But the reason they're not getting a negative is because of division. Remember, division takes out the negative, just like multiplication takes out the negative. So I sometimes forget that rule. So now I just reminded myself of why it's that way. So sorry about that. All right, so there it is. So whatever the index is, if you have a negative, it'll be gone. All right, if you guys need to leave, go right ahead. I'm going to do one more. So you just watch the end of the video, or if you want to hang out, we'll get this done. All right, so now let's look at the ramp facilities, right? The ramp facilities for me is calculating an index of 1.07. Now I'm going to double check that that is what I expect. So here is my present value of my cash flow. There's the investment, and I have something left over. So it's reasonable for me to look at this and see that the index is over 1, right? Because what's the threshold? We want to make sure it crosses at least 1. So I'm going to put that in there, and they want it to 2 decimal places. And then double checking my computer network is calculating. So I've got my present value, total cash flow, subtracting that investment amount. And there's my net present value. And I'm actually getting an index. And by the way, that is not $1. So I'm taking that out. I don't want you to think that is $1. That's just a number. It's just a number. It's an index. So no dollars when you're asked for an index. But what's interesting is we've got these 2 analysis. If you're going to use this one, here's your winner. But if you're going to look at this one's your winner. And you say, why is that? Because what's happening is the timing of the cash flow. That's what's going to matter. And we'll explain that here. But here's your total cash flow, right? So here's the thing. This project, the comparing, remember when you divide something, you're really comparing something. So if you compare the amount of the total cash flow with the investment, so every $1 of investment you put in, you're getting benefit of $1.10. Every $1 here in the ramp facility option, every $1 invested here is only benefiting you $1.07. So you've kind of got 2 conflicting results to try to pick which one to do. But then that's where you start looking at a couple of other things. So let me go ahead and just finish this out. The blank has the largest present value index. Mine was the computer network. Computer network for me, which I think hopefully will be yours. Although the ramp facilities has the largest net present value. Yep. It returns less present value per $1 invested than does, okay, so let me read this again. it returns less present value dollar per, but less present value per dollar invested than okay. Well, this one was a complete bust because, all right, I'm still having trouble. My reasoning skills just left my head. All right, one more time. Although the ramp facilities has the largest net present value, it returns less present value per dollar. By the way, that's the index. Even though they're using a different, they're calling it different by name. That should say it returns less of a index, okay? Present value index. They're calling that present value per dollar. So once again, it makes me mad that they're not following their language. Okay, so it was the computer network. This one is smaller than this one, but up here, this amount is bigger than this one. As revealed by the present value index. Okay, now they're saying it. The present value index for the blank, that's the maintenance equipment, is less than 1. Okay, yep. Indicating that it does not meet the minimum rate of return standard. So when you get a negative number here, not only does it, I said that the benefits were the costs were worse, were bigger than the benefits. And that's basically what it is. So see, I kind of gave you a little bit different way to look at it, but that's okay. It didn't meet their minimum required rate of return. And remember, mine is 12%. All right, so that's kind of the idea. So even when you're using the time value of money, both of those analyses are different, and you're going to get different explanations. So you might have to look at other things. Okay, you might have to look at other things. So that's all right. Let's move on. Let's finish up this last one. Oh, let me make sure that I've got everything in there the way it should read. Okay, this last one is just doing 2 projects. We're going to do the net present value and the one called internal rate of return. Okay, internal rate of return. So let me go grab it. So we're back to just 2 projects. Okay, 2 projects. Let me start in. What's the very first thing that, my opinion, you should go look up and see where it is to go try to find some minimum rate. Their minimum required rate of return. I think that's almost the most important piece you can go find, because that's going to dictate everything else from there. Okay, so I want this to line up. A little picky. All right, bring them up. All right. All right. Okay, 10%. 10% will be what we're going to find when we do the internal rate of return. I'll explain that. We're going to do the net present value first. The good news, look at this. Here's the good news. What did I say about annuities? If they're all the same, every payment, woo, we got an annuity. You're like, what is the big deal? Well, I'll show you. We get to use a different table. We only have to make one calculation for the cash flows. Okay, so let me explain. We're going to do 4 years. Okay, gonna do 4 years, and we are going to. So I did key in all 4 amounts, and I wanted to know what its total was because they didn't put a total there. That's fine, but now, okay, remember I've got a new rate of return. Okay, so let me take out, and then I also need to put an investment amount too. Okay, so for the wind turbines, turbines. Okay, that's what I thought. Aren't those big white things? Some people don't like them, but I figure if they create energy, you can put one in my backyard, wouldn't bother me any. Okay, the investment needs to be in because they're different. Okay, so the wind turbines for me is 485,350. Okay. The other one is a biofuel equipment. Well, its investment is higher. It's 1,032,580. Okay, so now I've got my investment amounts for both of those projects. Now I'm going to fill in my cash flows. And like I said, we get the benefit of having an annuity as a cash flow, which is a little easier to work with. Okay, so you're just going to key this in and make it if you want. Or you can just key it in once. I don't care because we're only going to be doing one calculation. Okay, one calculation. Now we are adding up what those net flows is. This is before present value gets figured. Here's the cool thing. Because this is an annuity, we are going to use a table that says annuity, right? And when we do, we're going to look at the column of 10%, and then we're going to take it down to the 4th year. So, and now look, our numbers are starting to look different after the 1st year because this is taking into consideration all of these separate present values. They're adding them together. All right. So when I get to 4 and 10%, here is my present value factor of an annuity. I'm going to key that in, and that's going to go in my first row. It's 3.170. And I'm only going to use one because remember, this is 4 years. And the present value factor of these 4 years worth of cash flows, it's got to be under 4. Okay, because it's got to be less than 4 because we're looking at 4 years into the future. So when I just use the one, and by the way, that's the only table we have, so we couldn't even go back and use that other table if we wanted to. Here is the cash flow at the end of the 4 years. Okay, there it is. What is the cash flow without the present value? See the difference? That's, yeah. So, all right, let's do the math. So here's the cash flow after the 4 years at present value. I need to make sure that this is the investment that I said it would, and it isn't. So I've got to make that equal that. Okay, so my answer is not right yet. If you guys need to go, that's okay. All right, so I'm going to subtract the investment.
Miss Rhonda.
Yep.
Are we, do we have class on Tuesday?
Okay, so here's what we're doing. I've got to create the final and the review. The review
Is it a final, or is it just a test over the last 2 chapters?
It's a final over 7 of the 12 chapters. You'll know what they are. The actual review is one we use for all of our classes. So that was created by another teacher, but you're going to be able to follow it, and it's on paper, and I'm going to put it out in the module for you if you want to download it and learn it yourself. But then I'm going to go over it on Tuesday. If you want to come in, if you want to come in, you'll get your work ethic points. If you want to join on Zoom, whatever you want.
Yeah.
And then if you still need some more help, come Thursday. Okay, but that final has to be done and entered by Friday night at 11:55.
Yeah, it'll be online though.
It will.
Yeah.
It will.
And then
It'll be in Cengage.
Is the paper review worth points? Just
Yeah,
like the other ones?
and I'm not real sure how to give you the points other than you being here or on Zoom. Yeah, but I want to offer some points for it. So probably what I'm going to do, no, I'm going to do it. I'm going to give extra credit for your work ethic points. For showing up.
Yeah.
So those are even more valuable. What do you think of that? Woohoo! So, yeah, I'll just do it that way.
Now, me and Reagan will be
You
here.
can tell me I'm just giddy.
No, me and Reagan will be here, we'll see you next week.
See you later. Thanks a lot. Okay, we're gonna finish up if Molly's still with me. All right. Hang in there, Molly. We're gonna get through this because I'm still recording. So those that are watching the video are gonna hear all the laughter going on. Okay, back to where we're at. We're looking at wind turbines and biofuel equipment. We're trying to come up with a present value for the cash flows of each of these projects. The good thing is we've got an annuity going on here. So all we need to do is calculate this once to get this number. Then we need to subtract the investment. I want to make sure my investment is 485,350. My other investment, okay, and I need, and it is the same present value factor for both of these, but the cash flows are different. So you would want to make sure that gets keyed in. So here is my present value of my cash flow. And now I need to make sure that my second project, I'm going to key in 1,032,580. So just like in most accounting problems, you have got to watch every little step you make. Okay, and I'm going to put that in as a negative so that we get, when we get our net present value. So here comes putting in the net present value for both of these. So based on whichever one's larger, this one looks pretty decent. Okay, so let's put these in, but then we'll talk about something here in just a minute. So let's just rekey. I think we're getting used to keying in our present value, our net present value of different projects. And I think hopefully you're starting to see that using different analysis provide different information. And each of these analysis that we have pros and cons. Okay, they have pros and cons for using them. And some businesses maybe won't use one or the other just for their reasons. And guess what? It's up to them what they want to use because they're the ones calculating this information to try to justify which capital investment to make. Okay, and if they screw it up, then it's on them, right? So, yeah. So if you are working in this department for a particular business, you probably really want to double check everything, that even your estimates that luckily we didn't have to help with. All right, so now I'm going to put the net present value of both of the projects. And I just want to double check. Uh-oh. Now let me see what I did. So once again, okay. Okay, hang on a minute. Let me see what's happening here. I bet you, yep, my biofuel has different annuity. Yep. So once again, I'm tooting my horn for my template here that allows me to make a quick change and rectify why it's wrong. Yep. So once again, you just about can't be too careful. All right, so now we're getting different numbers. All right, so now let me put in those different numbers. What I put in for the investment was working out, but not the present value of the total cash flow. Okay, so let's put that in. Okay, and actually, yeah, so actually this looks a little different now. Sorry, I had that not correct, but once again, all right, there we have it. So now that I have my correct numbers in, this one doesn't look so great. In fact, the wind turbines seem to be the better choice with this analysis. Okay, now we're going to do that present value index. Okay, we're going to do it again, and then we'll do the internal rate of return. So I'll try to kind of hustle it up now, and that's okay. All right, I've got a place to put the present value index, okay? Present value index, let me remind you what it is. It's just a number, and we want it to be at least 1. 1 means that the benefits and the costs equal each other. So we're going to take the cash flow we're expecting and dividing it by the investment. When we do so, we do get an index that's higher than 1. So we are going to benefit based on our analysis here. And then when we do the same thing here, we're using that cash flow and dividing by the investment, but the biofuel one, the biofuel one is still lagging behind with the present value index. So the two present value analysis that we did so in favor of the turbines for the net present value and the present value index. So let's put our indexes in, okay? And I want to make sure that I'm putting the right one in the right spot. Okay. And so if this was all you did, boy, I think you would really probably both analysis favored wind turbines. Now let's see if the internal rate of return does this. Now this one's a little trickier. So let me show you what we're going to find. And I want to make sure that I've got everything keyed in right. Let's go back to, I've got a place to calculate this internal rate of return. That's blank right now. Okay, so let me work with you on how to do this. Make sure your investment is what you are expecting. Yep. Okay, so that needs to be down somewhere. My annuity amount is 170,000 each year. Make sure that amount is showing up. Now, here's where I don't have the right number. So I keyed this in last night because I was in a hurry. But what I really want it to do is make it equal one of those years, okay? And now I'm going to take this out. Okay, I'm taking it out because I want to show you we're going to calculate a present value factor. Okay, we are going to calculate it. So the present value factor is going to take the investment, okay, and divide by its annuity amount, right? So yeah, the internal rate of return is a lot easier to calculate when you have an equal amount every year, okay? So here we go. I just want to show you real quick. Sorry, I don't think I brought in. Here it is. Huh? Yes. This is the procedure for finding the internal rate of return. Yes. So you have to use this process to find internal rate of return. So here's the first thing you find. The first thing you find is a factor. So we're actually going to go find a factor, and then we're going to go look for it on the table and try to find one that's as close as we can. If it's not exact, find about as close as we can get it. And then we're going to go up to the top of the table to see what the percentage is that corresponds with the factor that we just found. Okay, but to find the factor, you need the amount you invested, and then you need an equal annual net cash flow. If you didn't have equal, then you would need to make one equal. Well, down here, the fact that we actually have an annuity here saved us, because if these were all different, we would have to take the total and divide by 4 to get that answer. but because these are the same, we can use just one. So now I'm going to take, and so here's the formula. It's the investment divided by that annuity amount, okay? If you don't have annuities, then you're simply going to have to take the amount of the cash flow and divide it by however many years you have. So luckily, we didn't have to do that. Here is the factor that I'm going to go look at the table here in a minute, and that's what they want for our first input cell there. Now let me do the math here. So down here, the biofuel equipment had an investment of $1,032,580, and we want to divide by the annuity amount because it's equal. And here is the present value factor for this one. Now we got to go look at the table to find the corresponding internal rate of return. So let's put the factor down that we got, and they want it, be careful, if required, round your present value factor answers to 3 decimal places. Well, I've got mine at 5 because I wanted to make sure, and both of mine stop at 3. Okay, so I'm going to go ahead and key this in, but only to the 3rd. All right, so let's see. And I'm going to make sure that I put wind where wind goes and biofuel where biofuel goes. I'll tell you, my level of detail right now is what I call my tax return level of detail. I feel like every little move I make, I actually want to double check it and triple check it. Let's see. Oh, thank goodness. All right. So now here comes the 4th part. We got to go back up to the table. Let's go find the wind turbines present value factor somewhere on this table. Oh, there it is. And it is exact. Guess what? It's usually not exact. So sometimes you have to split the difference and look at a different table that has more detail, you know, because that's 5% between those two there. So a real table is gonna, yeah, anyway. So the internal rate of return for the wind turbine is 15%. And I'm gonna go ahead and finish out my recording here so that you get it. So this one then is 15%. Okay, we're gonna now look for the factor for the biofuel equipment. It's 3.37. Well, it is 12%. Okay, 12%. All right. And if you remember, what is our minimum? It's 10%. So either one of these could be, it definitely surpasses our minimum. But based on the information we have, the wind turbine, so the wind turbine beat it in net present value, it beat it in the present value index, and now it's won for internal rate of return. So you want to talk about a triple threat. It looks like the old wind turbines are our best investment in that. So, and look at the amount that gets invested. Okay, so let's just check. This is 12. See, I already made a mistake. Okay, let's read it. The net present value, the present value index, and the internal rate of return all indicate that the wind turbine is the better option compared to the biofuel equipment, although both investments meet the minimum return requirement criteria of 10%. Yes. Okay. Let me see if I got it right now. Okay. So the other thing I want to make mention, because we're done, the only thing I'd make mention is, golly, look at the investment. You know, this is half of what that one is. Half, right? So that also might be a consideration. You know, if you don't have $1,032,000 to do the biofuel equipment stuff, you know, that might also justify the turbines. All right, that's it. I'm sorry it took so long. I am so very glad that I dwelt over this for quite some time because I wanted to try to make it a little more make it so you could grasp this a little bit, grasp it just a little bit. So I made some numbers down here that compared these two, like the total cash flow, right? What's the difference in the total cash flow? All right, that's 100% difference. Here is the investment difference, right? So this one is 113% of this one. And then the net present value, right? This one is lower by this one, 16%. So having these numbers sometimes also helps the picture of what's going on here. That's it, guys. I am going to stop my share and we'll see you on the next video. Okay, thanks for joining us. And then I will put in the attendance. Okay.